We are almost done here with the educational series on long-term care planning and insurance. In fact, we are now at section 4, which is showing you how to customize your own plan. And we're going to jump right into that. It's important to point out here that I don't work for an insurance company specifically. We do represent about 8 or 9 different long-term care insurance providers. And in order for all the other products to make sense, the life insurance plans that have long-term care riders, or the annuities, they call them combo plans or hybrids. In order for those to make sense also as part of your options to consider, it really does all kind of come back to understanding how long-term care insurance works traditionally. And some of the things that we look at when we decide which carriers we want to work with for our clients is we want to know how long they've been in business for. We want to know what their claims paying experience is. We want to know what their ratings are from some of the top ratings companies like Standard & Poor's and Moody's and Fitch and so on. Also, their history of rate increases on existing policyholders is important. And then lastly, do they have significant assets in surplus? So really, quite frankly, they're there when we most likely need them, which is really at claim time. So those are some of the things that we look for in carriers that we want to work with. And I'm sure those are pretty much in line with what you'd be looking for as a consumer. And our job is to really act as kind of like the middle person. So we work with 8 different carriers, and we can help bring that level of objectivity, to you as a consumer. And when you go into designing a long-term care plan, there really are 4 core features that go into customizing your own plan. Then the last bullet point here says riders, and we'll talk about that too, but those are really extra bells and whistles. The first core feature is either a monthly or a daily benefit. So what you basically say when you design a policy is, I can choose anywhere between $1,500 and $15,000 per month of benefit, which translates back into about $50 to $500 per day of coverage. So the first thing you want to look at is really, what are the average costs of care in your area? Number one, because the costs of care are different in Shreveport, Louisiana than they are in Manhattan or Anchorage, Alaska or Chicago or somewhere else. So question number one is, what's the average cost of care in your area? Number two is, how much protection makes sense for you to have? You might not need to insure against the whole risk, but you might want to have a partial amount of coverage so that you feel like you're not completely exposed, to long-term care. Now, the only difference between a monthly benefit and a daily benefit is that a daily benefit caps you out at that amount each day. So, for example, if you had a $200 per day or daily benefit and you went on claim and your care was $210 one day, you'd be out of pocket that $10. If your care was $180 one day, depending on what kind of policy you have, you either get $180 or you get the full $200. So a monthly benefit does not look at the actual costs day by day. It just says whatever your bill was for the month, that's what you're going to have access to. Now, when you have the monthly benefit or the daily benefit, you're going to be able to have that either as cash, okay, they call those indemnity plans, or reimbursement, which means that we submit bills and then you get reimbursed. And I can talk to you more specifically about that. My job in this video is just to give you an idea and an overview of the different coverage options and how they work and how you pick them. So option number one is a monthly or daily benefit. Option number two is what they refer to as a benefit period. And this is the length of time that you can use your policy for once you become benefit eligible, once you go on claim. Okay, this does not kick in until you've made a claim on your policy. So for example, you can choose 2 years or 3 years, 4 years, 5 years, 6 years, 7 years, 10 years, lifetime. It varies company to company. Most claims fall between 3 and 6 years. And so when we help people design a plan, we help them get an amount of coverage that provides them with what's referred to as peace of mind, but also for an amount that they feel is reasonably affordable. So the benefit period is how long your policy lasts for, not from when you buy it, but from when you ultimately go on claim to use it. Now, what you're really buying is you're buying a pool of money. And I think it's easier for people to understand even how the years work when we put it into the pool of money concept. Now, you can have a monthly benefit, like I mentioned, or a daily benefit. And if you had a monthly benefit, you could use that benefit of $6,000 a month, for example, every month for the year, so 12 months. Or if you had a daily benefit of $200 per day, then you could use that 365 days in the course of a year, theoretically. And then you multiply that by however many years you purchased as a benefit period. So for example, if you bought $6,000 per month of coverage, you could use that every month, in the course of a year. And if you bought a 4-year benefit period, what that really means is that you just bought $288,000 of long-term care coverage. So now think about that. Instead of going to your 401k or your mutual funds or your stocks and bonds or your house, this is your account that you've earmarked and you've set up specifically for long-term care. Now, the third option is what's referred to as the elimination period. And this is really a fancy word for deductible, right? How many days you're responsible for paying first before the insurance kicks in. Do you have no deductible? Is it 20 days, 30 days, 45, 60 days, 90? Again, it varies company to company, but the longer you take on the risk in the beginning yourself, the lower your premium. If you want to get your benefits right away and have less of a deductible or no deductible, then the premium goes up accordingly. So my job is to really help you figure out which of these coverage amounts makes the most sense for you, but I want to give you an idea of the options that are available anyway. And then the last option, and I'm not going to go into great detail about this either at this particular point, but you can choose either a compound inflation protection option or a simple inflation protection option or what's called GPO or FPO, guaranteed purchase option, or a future purchase option, where the company gives you the opportunity to buy more coverage every, for example, 2 years or 3 years or 5 years and so on, or you can have no inflation protection. Now, the inflation protection is probably one of the most misunderstood parts of the plan design. And when you're designing a plan, having the right inflation option actually has a lot more to do with your age than anything else. So it's imperative to understand the inflation options when you design a plan for yourself. And it does impact the cost, but we can actually sit down with you on a conference call and we can show you exactly how this works and the importance of it. Then the last part really are some of those, what they're referred to as riders. These are extra additional features to consider. Half of them include a spouse, so if you're single, these might not even be applicable, but you can have shared care, okay, where a partner or a spouse can actually share a policy. 3 years and 3 years, but together you really have 6 years. And if one of you dies and never uses your policy, you can leave the unused portion to a beneficiary, to your spouse or to your partner. Survivorship basically says that if you both have a policy and it's in force for 10 years and neither of you dies or goes on claim, then after that 10-year period, when one of you passes away, the remaining spouse has his or her policy paid up for life and has no more future premium payments due. So it's a nice feature, especially for younger folks. The waiver of the elimination period for home health care basically says you can have a 90-day or 100-day deductible for a nursing home, which is great because health insurance or Medicare could pay up to the first 100 days. And if you add this rider on, which says the waiver of the elimination period for home health care, that means that you could have no deductible for care when it starts off at home, which, as we mentioned before, about 82% of long-term care starts off at home. Nice feature to consider for sure. Then you have restoration of benefits, okay, which basically says if you were to go on claim and then you were to get better and then you were carefree for 180 days, which is 6 months, then your policy would restore back to its original value. And that could be a great feature to consider for some folks as well. The non-forfeiture benefit basically says you could pay a little extra on your policy, and as long as you paid into the policy for 3 years, if you wanted to cancel it at any point thereafter, you wouldn't lose the money that you've put into it up to that point in time. You would actually have that kept aside for you as a reduced pool of money, equal to the sum of the premiums that you've paid in, to be able to use at claim time but not have to make any future premium payments. And then return of premium is basically exactly what it says. If you were to die and never use your policy, the premiums could come back to a beneficiary. That way you wouldn't lose the money. It may or may not be the right fit for you, might or might not be the right rider, but this is just a glimpse of some of the options that are available. And People ask the question all the time is, when should I buy long-term care insurance? Well, a wise Chinese proverb says the best time to plant a tree is 20 years ago, and the next best time is today. So probably, the younger that you are, the healthier that you are, the better this coverage is. But I wouldn't wait any longer, to obtain this coverage if you're still eligible to get it today. So we've gone through longevity, we've gone through understanding what long-term care is, we've discussed what your options are, and we've taught you how to customize your own plan. The only thing left is to give you a sample of some of the different costs so you can get an idea of how much it costs for certain amounts of coverage. So that's going to be the very last video, and we'll see you on Section 5.